Welcome to The Explainer. Today, we are digging into the Viatris third quarter earnings call. And let me tell you, it was a weird one. We saw some really solid headline numbers, but the market's reaction was, well, not what you'd expect. All right, let's just get right into the big question. The mystery of the quarter, really. Viatris comes out, they beat revenue, they beat earnings, they even raise their guidance for the rest of the year. So what gives? Why did the stock get hammered, dropping almost 6%? It just doesn't add up on the surface. So first up, let's just lay out the evidence. We're going to look at these two totally opposite signals that investors were trying to make sense of on the morning of November 6th. I mean, just look at this. It's a tale of two tapes, isn't it? On one side, you've got everything you'd want to see. Revenue beat by about 4%, adjusted earnings beat by a solid 6 to 8%, and they told everyone the full year is going to be even better. A classic beat and raise. But then you look at the other side, and it's a bloodbath. The stock sells off almost 6% on volume that's 2, even 3 times normal. That's not just a little profit-taking. That tells you big money was heading for the exits, and fast. Okay, so to figure out what happened, we have to do what the pros do. We got to pop the hood and look past those shiny headline numbers to see what was really going on underneath. So, the top line? It looked great. Revenue came in at $3.76 billion, blowing past what analysts expected. No red flags here. And yes, same story with the earnings per share. They reported 67 cents, which was a very nice beat. So if you just stopped here, you'd probably be buying the stock, right? Everything looks fantastic. But, and this is a huge but, those were adjusted numbers, non-GAAP. And that's the key. It means they've pulled out certain costs to, let's say, paint a prettier picture of how the business is doing. It's not the whole story. Because when you look at the official accounting numbers, what we call GAAP, well, Viatris actually lost money, $128 million to be exact. That's a loss of 11 cents per share, and that was thanks to things like a write-down on an investment and higher taxes. For a lot of serious investors, a real loss is a real loss, no matter what the adjusted numbers say. And then there's this problem, what management is calling the Indore Impact. Basically, they got an FDA warning at one of their big facilities in India, and it's causing all sorts of problems. It was a direct hit to revenue this quarter, costing them about $100 million. It's a serious operational headache and a stark reminder of how fragile these global supply chains can be. Okay, so we've got a GAAP loss and a big operational issue. But, and here's the bull case, even with all that, the company is an absolute cash machine. It turned out $658 million in free cash flow. That's the money left over after running the business, and that is what pays for things like dividends and buybacks. It shows you the core business is still incredibly healthy. So with that complicated picture in mind, let's switch gears and talk about management's game plan. How are they trying to steer the ship from here? The CEO, Scott Smith, basically came out and said, hey, look, we're focused, we're executing our plan, the underlying business is strong despite these headwinds, and we're moving in the right direction. It's a message of keep calm and carry on. And the centerpiece of that plan is this massive strategic review. They're literally tearing the whole business apart, looking at everything from sales and R&D all the way down to the supply chain and corporate staff. The whole point? To find, in their words, meaningful net cost savings. And of course, they wanted to get investors excited about the future. They pointed to some big things coming up in the pipeline. New drug applications in Japan pretty soon, a likely FDA approval for a women's health patch next year, and then a really important data readout for their lupus drug at the end of 2026. So they're saying, stick with us, the good stuff is coming. But, as you know, the Q&A session with analysts is where the rubber meets the road. This is where you find out what the market is really worried about. And oh boy, did they have questions. The analysts really grilled him on the same few points. They kept asking, when is this Indore problem actually going to be fixed? Give us a date. They pushed back on the cost savings, saying, what does significant actually mean? Give us a number. They wanted to know the game plan for new drugs and how they'd spend their money next year. And really, all these questions boil down to one big one. Execution risk. Can we trust you guys to actually do what you say you're going to do? So let's put it all together. After digging through the numbers, the plan, and the tough questions, here's our take on Viatris heading into the next quarter. You've got this incredible tug of war going on. On the one hand, the bulls have a great argument. This company gushes free cash flow. It's returning a ton of money to shareholders, and this whole pivot could unlock a lot of value. But the bears have an equally strong case. They'll point to the Indore mess as proof of execution risk. They'll highlight the GAAP losses. And they are, frankly, very skeptical that this cost savings plan will deliver. And because of that perfect balance between the good and the bad, between that amazing cash flow and the very real execution risk, we're calling this a market perform. Viatris just has too much to prove right now. Until we get some real answers on fixing Indore and see some actual numbers on cost savings, we think the stock is probably just going to tread water with the rest of the market. Now, for our wild but plausible idea. The market is clearly worried, but look at what happened after that big drop. The stock rallied back about 10%. That tells you there are buyers who think it's cheap down there. So here's the trade. Consider selling cash-secured puts with a strike price a little below that post-earnings low, say around $10. Here's the cool part. One of two things happens. Either the stock stays above your price and you just keep the cash premium for selling the put, or the stock drops and you get to buy shares of this cash flow machine of a company at a price that the market has already shown it's willing to defend. And as always, just a quick reminder for everyone, this is for informational and entertainment purposes only. It is absolutely not financial advice. Please do your own homework before making any investment decisions.